Ever feel like you're just wading through tons of information, wishing someone could just, I don't know, point out the important bits, the shortcuts to understanding?
Yeah, like a map through the jungle sometimes.
Exactly. Well, that's pretty much what we're doing today here on The Deep Dive.
We are indeed. We're diving into something really quite fascinating and actually incredibly useful. It's an examiner's report for the UK taxation exam, the TXUK one, from March-June 2025.
Now, an examiner's report might sound a bit dry, maybe just for students.
You'd think so, wouldn't you?
Yeah.
But honestly, no. This thing is a goldmine for anyone wanting to get a real grip on UK tax. Especially those tricky areas, where people often stumble, even professionals sometimes.
Right. Think of it as getting some insider knowledge, yeah. Finding out where the common mistakes happen. It's like a shortcut to getting properly informed, cutting through the jargon to find those aha moments that actually make a difference.
Precisely. And for anyone not familiar, these reports aren't just pass-fail summaries. They give you a peek behind the curtain, how questions were answered, what worked, and crucially, what didn't. It's constructive feedback, straight from the markers. This one's from a computer-based exam, so questions vary, but the report uses sample questions to guide people.
Okay, so our plan for this deep dive is to follow the report's layout. We'll start with Section A, that's the objective test questions, the multiple choice type stuff.
Testing that broad knowledge.
Then Section B, which is more of a case study, gets a bit more complex, seeing how different rules interact.
Yeah, things like inheritance tax often pop up there.
And finally, Section C. That's the constructed response part, where you really have to show your workings, detailed calculations, and explanations. We'll pull out the key nuggets, the practical stuff from each section. Ready to jump in?
Let's do it.
Okay, Section A first. Navigating the objective test landscape. These really test the breadth of your knowledge, right? What's the main advice from the examiners here?
It boils down to cover everything. Seriously. They really stress that you can't just question, spot, or guess topics. You need that solid foundation across the entire syllabus because these questions can come from anywhere.
Makes sense. So let's look at an example. First one, ELSA and National Insurance Contributions, NICs. ELSA works for BLTD. She gets a gym membership that costs the company £900, though the normal fee is £1,000. Plus, BLTD paid £1,800 into her pension. The question, how much Class 1A NICs does BLTD owe for ELSA?
Okay, here's the first key insight, and it's a really common mistake area. For Class 1A NICs, that's the employer's national insurance on benefits in kind, you must use the actual cost to the employer.
Ah, so the £900 for the gym, not the £1,000 normal fee.
Exactly, use the £900. And the other crucial part, pension contributions. They're completely exempt from Class 1A NICs, completely ignored for this calculation.
Right, another easy tripwire. People might just add all the benefits together or use the market value.
Very common. So the calculation is just that £900 costs times the Class 1A rate, which is 13.8%, giving 124 board.
Sure.
Shows how knowing those specific rules is vital.
Definitely. Okay, next example. Amir and gift holdover relief. Amir sells his 35% share in a manufacturing partnership to his daughter for less than it's worth. He also gifts shares in an unquoted investment company, so non-trading to his son. The question was, which disposal gets gift holdover relief?
This one really tests your understanding of the conditions for specific reliefs. It's easy to think, oh, it's a gift, there must be some relief, but it's not that simple.
Yeah, the details matter, don't they?
Hugely. Gift holdover relief lets you delay paying capital gains tax, which is great. And this is the absolute core of it. It's only available for assets used in a trade.
Okay, so it's about supporting actual businesses, not just shifting investments around tax-free.
Pretty much, yeah. So the partnership interest, because it's a manufacturing business, qualifies. But the shares in the non-trading investment company, nope, no relief there.
Got it. Trade assets, yes. Investment assets, no. Clear. Moving on to VAT, Alpha Ltd, and Group VAT registration. Alpha owns 100% of Beta Ltd and Gamma Ltd, but only 35% of Delta Ltd. Everyone makes standard rated supplies except Gamma, which makes zero rated supplies. Question, who can join Alpha's VAT group along with Beta?
Right, VAT grouping. The fascinating bit here is the control condition. The rule is pretty strict. You can only include companies where the parent holds more than 50% of the shares.
So straight away, Delta Ltd is out because Alpha only owns 35%.
Exactly, gone. That leaves Alpha, Beta, and Gamma all 100% owned, so they meet the control test.
But what about Gamma making zero rated supplies? Does that matter?
Good question. And no, it doesn't disqualify them. Zero-rated supplies are still taxable supplies under VAT rules. They're taxed at 0%, but they're still within the system. So Gamma is perfectly eligible. The answer was Gamma LTD only because Beta was already assumed in the question.
Okay, understanding the specific thresholds and definitions is key. Final one for Section A, Ruby and late self-assessment penalties. Ruby filed her 2023-24 online tax return on 30 July 2025. Question: what's the maximum penalty she'll face?
The dreaded late filing penalties. Let's unpack this. The online deadline for the 2023-24 tax year was 31 January 2025.
Right, and Ruby filed at the end of July 2025, so that's 6 months late.
Exactly, 6 months late. Yeah, the penalty system really ramps up. You get an initial automatic £100 penalty just for being late.
Okay, standard hit.
But then once you're more than 3 months late, additional daily penalties kick in. It's £10 per day.
Oh, wow. So for being 6 months late, she was 3 months into the daily penalty period.
Precisely. 3 months is roughly 90 days. So 90 days times £10 a day is £900.
Plus the initial £100?
Yep. So 100 plus £900 makes a total maximum penalty of £1,000. It shows how delaying really costs you, much more than just that first 100 quid.
Definitely a cautionary tale. Okay, that covers the objective tests. Now let's get into the slightly deeper end with Section B, focusing on a more complex inheritance tax case involving Sally. We need to assume today's date is Feb 2025 for this.
Right. Section B often uses scenarios like this to see how you connect different IHT rules together. It's less about isolated facts and more about the bigger picture.
First question about Sally. What are the IHT advantages of making lifetime gifts?
Okay, 2 main advantages highlighted.
No.
First, a really important one. The value of the gift for IHT is fixed at the date you make it.
So if the asset rockets in value later, that growth is outside your estate for IHT.
Exactly. Potentially a huge saving. The second advantage is taper relief. If you survive for more than 3 years after making certain types of gift, the IHT payable on that gift might start to reduce, eventually reaching 0 after 7 years.
Might reduce, so it's not guaranteed.
No. And it only reduces the tax payable, not the value of the gift itself. And it's crucial to remember, lifetime gifts aren't always tax-free. Some are immediately chargeable. Others only become chargeable if you die within 7 years.
So the advantages are the fixed value and potential taper relief. Good. Now, onto a calculation. Sally made a chargeable lifetime transfer, a CLT, of £360,000 to a trust back on 28 March 2022. Before that, on 10 January 2020, she'd made a potentially exempt transfer, a PEAT, of £165,000 to her daughter. Question: if Sally dies on Feb 2025, how much additional IHT is due on that CLT?
Oof. Okay, this is where IHT gets properly intricate and where families can get nasty surprises. The core issue is how gifts interact with the nil rate band, the £325,000 tax-free allowance.
Right. How does that work when she dies?
Well, when Sally dies within 7 years of making the CLT, the IHT on it needs to be recalculated at the death rates, which are usually higher than the lifetime rates. But crucially, the nil rate band available for that calculation is reduced by any chargeable transfers made in the 7 years before the CLT.
Including PTs that become chargeable because she died within 7 years of making them, like the one to her daughter.
Exactly. That £165,000 PT made in 2020 now becomes chargeable and eats into the nil rate band available for the 2022 CLT calculation on death.
So the earlier gift reduces the tax-free amount for the later one?
Yes. And there's another complexity called grossing up. If the trustees pay the initial lifetime IHT on the CLT, rather than Sally herself, you have to add that tax back to the value of the gift before recalculating the tax on death. It ensures the estate bears the full brunt. The report said errors here were common.
Wow, okay, so prior gifts really cast a long shadow. That calculation worked out to an extra £74,750 in IHT, a significant hit.
It really illustrates the cumulative effect.
Next, valuing a Pete wedding gift. Sally gave £42,500 cash to her grandson for his wedding on 21 December 2024. She'd also made some smaller gifts to him in the previous tax year, 2023-24. Question: what's the value of the PET after all exemptions?
Right, this tests the specific exemptions and how you layer them. First, there's a specific marriage exemption. For a gift from a grandparent, it's 2 people, £500.
Okay, so knock off £2,500 straight away.
Yep. Then you apply the annual exemptions. Everyone gets a £3,000 annual exemption each tax year. So she uses her £3,000 for the current year, 2024-25.
And can she use last year's too?
Yes, you can carry forward unused annual exemption from the immediately preceding tax year. So she could potentially use £3,000 from 2023-24 as well. But the report notes she made prior gifts in 2023-24. Let's say those used up 1,500 pounds of that year's exemption.
So she only has 1,500 pounds left from 2023-24 to use against the wedding gift.
Precisely, you have to check what was actually available. Common mistake, the report said, was just deducting two full 3,000-pound exemptions without checking.
So 42,500 pounds minus 2,500 pounds marriage, minus 3,000 pounds current year annual, minus 1,500 pounds prior year unused annual, gives 35,500 pounds as the final peat value. You need good record.
Absolutely vital.
Okay, question 4. Chargeable estate value of retained shares. Sally owned 100% of Vanity Ltd., 175,000 shares. On 18 Feb 2025, she gifts 105,000 shares, that's 60% to her son, keeping 70,000, 40%. Share values differ. £4 for a 40% holding, £10 for 60%, £50 for 100%. If Sally dies just 2 days later, what value goes into her estate for the 70,000 shares she kept?
This is all about how valuation works when you break up a controlling interest. The value isn't just 70,000 times some standalone price. You have to consider the context.
So how is the value of those retained shares worked out?
It's based on the value relevant to that specific holding percentage. Sally retained 70,000 shares, which is exactly 40% of the company. The value given for a 40% holding was £4 per share.
So it's simply 70,000 shares times £4 per share.
Yes, 280,000 pounds. The crucial insight is that by gifting away the controlling 60%, the remaining 40% minority holding is worth significantly less per share than when it was part of a 100% block.
That makes sense. The value diminishes when you lose control.
Exactly. It's a key principle in IHT share evaluation.
Last IHT question. Sally wants to give 40,000 pounds for her granddaughter's 4-year university course. Sally's income is 60,000 pounds a year, and her normal living costs are 45,000 pounds. Question: how could she fund this gift so it's exempt from IHT?
This tests a really useful IHT exemption called normal expenditure out of income. For a gift to qualify, it needs to meet 3 conditions.
Okay, what are they?
1, it has to be part of the donor's normal pattern of expenditure. 2, it must be made out of income. And 3, crucially, making the gift must leave the donor with enough income to maintain their usual standard of living.
Right, so Sally has 60K in income and 45K costs, leaving 15,000 pounds surplus income each year.
Exactly. So the best way to make this exempt is to fund it from income as normal expenditure. Spreading the 40,000 pounds over the 4 years seems logical.
So like 4 annual gifts of 10,000 pounds.
That would fit perfectly. 10,000 pounds is well within her 15,000 pounds annual surplus income, and making regular gifts for education could establish that normal pattern. As long as it genuinely comes from income and doesn't force her to dip into capital or cut back her lifestyle, it should be exempt.
That's a powerful planning tool if you have regular surplus income. Okay, let's move to Section C, unpacking those constructed response questions. This is where you really have to show your workings and explain things. The examiner mentioned people struggled even with apparently straightforward bits here.
Yes, Section C demands more than just knowing the answer. You have to demonstrate how you got there and understand the underlying principles. Often, it's about applying rules correctly in sequence.
First up, Fiona. Calculating her trading profits for 2024-25 and 2025-26. Her accounts end 30 June, and she had 25,000 pounds in transition profits from the previous year, 2023-24, due to changes in the basis period rules. What was the key issue here?
The transition profits. The report specifically said many candidates simply ignored them. This is a huge error.
Because those profits have to be accounted for, right?
Absolutely. They must be spread and added to taxable profits over 5 tax years, starting from 2023-24. So for 2024-25 and 2025-26, you needed to add 5,000 pounds. That's 1/5 of the 25,000 pounds to her calculated trading profit for each of those years. It's mandatory.
A crucial adjustment to remember with those basis period reforms. Okay, next, Emily and her VAT registration date. Her sales went over the 90,000 pound threshold in September 2024. People figured out when she crossed the threshold, but what was the final bit they missed?
Nailing down the exact date she was legally required to be registered. It's like classic VAT detail.
It's not the date you cross the threshold, is it?
No. You're required to register from the first day of the second month after the month you exceed the threshold.
So if she crossed it sometime in September, the first month after is October, the second month after is November. So the date is 1 November 2024.
Exactly that, 1 November 2024. Getting that precise date was worth that final half mark. Precision counts in tax.
Definitely. Now, Garth and NICs again, but looking at reporting and payment, 3 challenges here. First, How are Class 1 NICs, the employee-employer ones, reported?
Yeah, this wasn't well answered, apparently.
Yeah.
Class 1 NICs are handled through the pay system pay-as-you-earn using real-time information, or RTI. Employers report electronically to HMRC on or before they pay their employees each month.
So it's an ongoing real-time process. What about Class 4 NICs, the ones for the self-employed, like Garth? How are they paid?
This was also poorly answered. Class 4 NICs are paid through the self-assessment system. The payment deadline is the same as the main self-assessment tax balancing payment date.
Which is?
For the 2024-25 tax year, the deadline for Garth to pay his Class 4 NICs would be 31 January 2026. Different system, different deadline compared to Class 1.
Right. And the third challenge for Garth was the employment allowance. What's the key restriction there?
Many candidates just didn't answer this, apparently. The vital point is that the employment allowance can only be used to reduce the employer's Class 1 NIC liability. It doesn't reduce employee NICs or Class 1A or Class 4. It's specifically aimed at reducing the employer's cost of employment.
Good clarification. Okay, on to Chica and her income tax calculation. Several issues here. Let's start with calculating her tax-adjusted trading profit. What went wrong?
A few common errors. One was pre-trading advertising costs. Some people added them back, but actually they should be deducted once trading starts. Then capital allowances, always tricking.
Especially with private use.
Yes. Chica had a car with 80% private use. The capital allowance calculation needed restricting twice, first for the period she owned it in the year, say 812ths, and then by the 80% private use. But her delivery van, that qualified for the 100% annual investment allowance, AIA, because it was fully for business use. Getting the right allowance for the right asset is key.
Okay. What about the next part, calculating the trading profits assessed for the tax years?
The report said this was generally answered quite badly. The task here was simply to allocate the given profit figures to the correct tax years based on basis period rules without making any further adjustments like for capital allowances again. The examiner stressed the need for clear workings, showing the figures year by year.
So less about calculation, more about understanding the assessment rules and presentation. Finally, Chica's overall taxable income calculation. What were the nuances here?
Well, overall, it was better answered. But still, little details tripped people up. Property income, rent that was due but hadn't actually been paid by year end had to be taken out because it's usually taxed on a cash basis.
Okay, cash received is what counts generally.
Right. Then she replaced a dishwasher. If she bought a much fancier, upgraded model, she could only deduct the cost of a like-for-like replacement, not the full cost of the upgrade.
Sensible rule. What else?
She let a furnished room jointly with someone else. The taxable income from that needed to be split 50-50.
Yay.
Interest from gilts, that needed to be prorated for the time she actually owned them during the year. And the final, really common mistake.
Go on.
Forgetting to deduct the personal allowance. The question asked for taxable income, not the final tax bill. So after adding up all the income sources, you have to deduct the personal allowance to get the taxable income figure. Easy oversight under pressure.
Absolutely. Those final steps are critical. Okay, last case. Flightpath Trading Ltd, a company dealing with a tax loss. First, calculating the tax-adjusted trading loss. What were the points to watch?
Again, capital allowances caused some issues. One subtle point was expenditure on movable partitions that needed picking up from a list of disallowed admin expenses, not from separate info. Also, if van disposal proceeds were given net of something, you had to remember to gross them up to find the actual proceeds figure for the calculation.
And what about the managing director's car having private use?
Yes. The examiner specifically pointed this out. Private use adjustments for cars are relevant for unincorporated businesses, sole traders, partnerships. For a company, the car is a company asset, and the director's private use doesn't directly adjust the company's trading loss calculation in the same way. Different rules apply.
That's a really important distinction between company tax and personal tax. Presentation was key here too.
Definitely. Clear workings for additions and deductions make it much easier to follow and get right.
Okay, next part. Applying the loss relief. How did people fare with using the loss?
They struggled with the specifics, even though the exam paper apparently provided a structure. A major issue was carrying the loss back to an earlier year, say the year ended 30 Sept 2023. You can only offset the loss against the profits of the corresponding period within that earlier year.
So if the current loss period was, say, 6 months, you could only offset it against 612ths of the previous year's profit.
Exactly. You had to restrict the carryback claim proportionally. Another point, qualifying charitable donations. They get deducted after you've applied loss relief, not before. Order matters again.
Got it. And the final part for Flight Path was discussing the loss offsetting options. How did that go?
Quite poorly answered, according to the report. People often just listed the options they'd calculated, like carry back, current year offset, but missed the bigger picture.
What was missing?
They needed to discuss all the possible options. That includes the ones already calculated, but crucially also the option to carry the loss forward to offset against future profits. That was often missed or just mentioned briefly.
And the discussion needed more depth.
Yes. It wasn't just listing, it was about explaining the pros and cons. For example, carrying forward might be better if you expect profit to be taxed at a higher rate in the future, making the relief more valuable then. It's about showing strategic thinking.
Right. Understanding of the implications of each choice.
Yeah.
Okay, so we've covered a lot of ground there. What does this all really boil down to? We've dived deep into this examiner's report.
I think it really shows just how much practical insight you can get from these kinds of sources, even if they seem a bit academic at first glance.
Yeah, it highlights where the common mistakes are, the specific details of the rules.
Yeah.
It really can boost anyone's understanding of UK tax, whether you're studying, working in finance, or just, trying to figure out your own situation.
It's definitely a shortcut to getting better informed.
Yeah.
We've seen it with Class 1A NICs, the strict rules for gift holdover relief, VAT grouping conditions, those complex IHT calculations and exemptions, and the strategies around company losses. It's about understanding the impact these rules have.
Moving beyond just knowing what the rule is to understanding why it's like that and what it means in practice.
Exactly. And seeing how even tiny details like that VAT registration date or the order of deductions can have real financial consequences. Understanding the why definitely empowers you.
Absolutely. It helps you move beyond just ticking boxes for compliance and allows for smarter financial planning, whether for yourself or a business.
So maybe a final thought to leave you with. This deep dive showed us hidden rules and nuances in tax. What other areas of everyday life might have similar hidden rules or complexities that, if you understood them better, could give you an edge or help you avoid common pitfalls?
That's a great question. Something definitely worth pondering. Until our next deep dive.